Right now, millions of amateur traders are staring at a screen like this, drawing lines on a candlestick chart. They've been sold a comfortable story. The promise is that if you connect the right dots, find a head and shoulders pattern, or wait for the RSI indicator to hit a specific number, you have a predictable map to financial independence. But look at the other side of the trade. Do the math geniuses at Renaissance Technologies or the ruthless macro traders at Citadel actually care about your support and resistance lines? Or do they view these popular retail tools with contempt? Taking basic charts at face value while ignoring how the multi-billion-dollar players operate is a direct path to wiping out your account. This chart shows exactly how retail traders operate. You spot a support level, buy the stock, and place red stop-loss orders just below it. But watch from a hedge fund's perspective. That geometric line means nothing. Instead, your stop-losses light up as a high-value target. By relying on the exact same textbook patterns on public charting software, amateur traders are essentially publishing the coordinates of their capital to the rest of the market. Broadcasting the exact price where you will automatically sell provides a clear roadmap for institutions looking to capture your capital. Technical analysis was born over a century ago with thinkers like Charles Dow. Information traveled by telegraph, and market behavior moved incredibly slowly. Because data lagged, human emotions like fear and greed took days or even weeks to fully price into a stock. Floor traders could easily spot these psychological ripples on a paper chart and write them for profit. This bar chart illustrates the reality of the modern exchange. Notice the massive gap. Human execution sits at barely 20. These high-frequency systems execute millions of complex orders in milliseconds. They do not feel greed, and they never panic. Tools originally built to map the predictable emotions of human beings naturally break down in an environment dominated by emotionless supercomputers. Walk into an elite quantitative operation, like Jim Simon's Medallion Fund, and talk about a cup and handle pattern. You will be laughed out of the room. They view standard retail charts as statistical noise. Quantitative funds bypass basic moving averages completely. They deploy advanced mathematics, machine learning, and alternative datasets to find microscopic price anomalies long before the human eye spots them. Then you have the macro giants, like Ray Dalio. They ignore the geometry of a chart in favor of the underlying fundamentals. To a macro fund, trends are not caused by lines crossing on a screen. Trends are driven by massive liquidity flows, shifting corporate earnings, and central bank interest rate decisions. Yet, a paradox exists. Institutions do watch your charts, and this diagram illustrates exactly why. Notice retail traders shorting right at the resistance line, and then a massive institutional buy order violently drives the price upward. This is a strategy known as liquidity hunting. Institutions manage positions so massive they cannot buy without moving the price. They purposely push stocks to trigger retail technical patterns, effectively engineering a self-fulfilling prophecy to absorb amateur capital and fill their own massive orders. Professional survival requires moving past basic retail habits and adopting the logic of an institutional desk. Rule number 1, always prioritize the macroeconomic context. A perfect breakout pattern during a period of rising interest rates and declining corporate earnings is a trap. The broader environment must confirm your setup. Rule number 2, rely on volume, not lines. Institutions leave a massive footprint in volume data that they simply cannot hide. If a breakout happens on low volume, it's fake. Follow the capital flow. Rule number 3, trade the psychology of the market. Instead of looking for perfect support, look for where retail amateurs are panicking. The smartest money waits to buy at the exact moment standard patterns fail and the crowd capitulates. Disciplined risk management and understanding probability matter far more than finding the perfect geometric shape on a screen. Looking out over the financial capital of the world, we see a game dictated by human psychology and global resource allocation. Hedge funds succeed because they have a superior understanding of how to manage risk, locate hidden liquidity, and calculate future probabilities. To survive in this arena, you must start anticipating where the giant institutions are moving next. If you want to master this perspective and decode how smart money actually operates, hit the subscribe button. We'll see you in the next breakdown.